Welcome back to Trader DNA. Now listen to this carefully, because this one idea alone can save you years of pain in trading. But here's the brutal truth. The more complex your strategy is, the more undisciplined you become. Complexity does not equal accuracy, ever. In fact, from real trading experience, the opposite is usually true. The simpler the strategy, the clearer the decisions. And the clearer the decisions, the more disciplined and profitable you become. Now let me show you something powerful, and I mean ridiculously powerful, even though it looks simple. Look at this chart right here. This is our sell entry signal from January 30th, 2026. Now pause for a second and really think, where is the best place to enter a sell? Is it here after the pin bar? Is it here? Is it after the pin bar plus bearish engulfing combo? Or maybe here, right after the bearish engulfing? Or maybe you're thinking, hey, all four of these look valid. Why not take them all? The correct answer is only one. This one. This is the only entry that truly has high probability, the smallest possible stop loss, and the maximum reward potential. And most importantly, it can be executed with discipline the same way every single time. The other entries, even though they look logical, they are random. And random entries lead to random decisions. Random decisions lead to guessing. Guessing leads to emotional trading. And emotional trading leads to one thing, your capital slowly bleeding to zero. Now look at this second chart. Same date, same idea. Another sell setup. Again, let me ask you, where is the best entry? First one? Second? Third? Or the fourth? Take a guess. The correct answers are here and here. Only these two. Why? Because only these entries meet all the conditions. High probability, small risk, large reward, and this is the key, they can be repeated with discipline. That's what makes them measurable. That's what makes them real strategies instead of gambling. So from all these examples, here's the rule you need to burn into your brain. A real entry signal must be executable with discipline. Every trader wants high win probability, small losses, and big rewards. Everyone. But if a signal cannot be applied consistently, if you can't follow it the same way every time, then it's not a signal. It's just a random entry disguised as a strategy. And now, this is where it gets exciting. Because I'm about to show you a trading strategy that uses an indicator most beginners completely misunderstand or don't understand at all. This strategy is a powerful combination of Williams R and RSI working together to pinpoint high probability entries with massive reward potential and very controlled risk. Simple rules, clear logic, no guessing, no overthinking. We're going to break it down step by step, clean, clear, practical. So by the end, you don't just understand the strategy, you can actually use it. All right, let's go through it one by one. All right, now we're stepping into the engine room of this strategy, the indicators that make everything click fast and clean. And trust me, this part is a game changer if you're serious about trading smarter, not harder. We're using just three indicators, Williams R, the relative strength index, RSI, and the exponential moving average EMA. That's it. No clutter, no confusion. With these three tools alone, you can instantly see the market trend, feel the strength behind that trend, and spot whether price is already too expensive or too cheap. Literally at a single glance. No guesswork, no overthinking, just clarity. So let's kick this off with indicator number one, Williams R. And this one is criminally misunderstood by beginners. Here's the simple truth. Williams R is a momentum indicator, and its job is not to predict the future. Its real job is to tell you when the market is getting exhausted. When price has been running too hard, too fast, in one direction, this indicator raises a giant warning sign. It helps you see when the market is out of breath, whether it's exhausted from going up or worn out from going down. In plain English, Williams R helps you answer one powerful question. Is this move still strong, or is it about to crack? And this part is extremely important, so listen closely. Williams R is not a click and buy or click and sell button. If you use it like that, you'll get destroyed. Professionals don't use it to randomly enter trades. They use it to filter trades. That's the secret. The real power of Williams R is this. It measures momentum fatigue. It spots early signs of potential reversals. It helps you find precise entry timing with small risk. And it protects you from fake price action traps that wipe out beginners. Think of it like this. Price action shows you what the market is doing, But 𝗚𝗏𝗪 tells you how tired the market is while doing it. And that difference? That's massive. This is exactly why professional traders never use 𝗚𝗏𝗪 alone. They use it as confirmation, not as a solo signal. It's there to back up your idea, to say yes, this setup makes sense, or nope, this move is already exhausted, stay out. When you combine that mindset with discipline, you stop chasing random entries, you stop guessing, you stop gambling, and instead, you start taking trades where the risk is tight, the logic is clear, and the probability is stacked in your favour. And we're just getting started. Because once 𝗚𝗏𝗪 is combined with RSI and EMA, the market starts speaking a language you can finally understand. Now, let's keep moving, because this is where things get really interesting. Indicator number 2 is the RSI. And in this strategy, we're not using it the way most beginners do. Forget overbought, forget oversold. We're looking in on one level only, RSI 50. So what does RSI 50 actually mean? RSI 50 is the neutral line, the power line. It's not bullish, it's not bearish. It's the dividing line that answers one brutal question. Who is winning right now, buyers or sellers? Think of RSI like a massive tug of war. When RSI is above 50, buyers are pulling harder, momentum starts leaning bullish. Pressure is pushing price up. When RSI drops below 50, sellers take control. Momentum turns bearish. Price gets dragged down. If price is the final result of the fight, RSI 50 is the center line of the battlefield. Now here's the part most traders get wrong. RSI 50 is not for instant entries. You don't blindly buy or sell just because it touches 50. RSI 50 has one main job, control and confirmation. First, trend confirmation. In a healthy uptrend, RSI doesn't live below 50. It respects 50, it pulls back, then snaps back above it. In a strong downtrend, RSI keeps getting rejected below 50. This is why professional traders refuse to buy when RSI keeps failing to reclaim 50. No confirmation equals no trade. Second, 𝗙𝗡𝗨 filter. Imagine this. You see a beautiful bullish candlestick pattern. Everything looks perfect, but RSI is still below 50. That's a red flag. That's weak momentum. That's how traders get trapped. Flip it around. You see a bearish pattern, but RSI is still holding above 50. Selling there? That's early. That's risky. That's how fake moves eat accounts. RSI 50 keeps you on the right side of force. And now this is what gets exciting, because next, we don't use RSI alone. We combine RSI with 𝗚𝗏𝗪, momentum plus timing, strength plus precision, and that's how we turn random signals into clean, high probability entries. Now this is where everything clicks together. We're combining RSI and 𝗚𝗏𝗪 to hunt for clean, high confidence entry signals. The kind that actually make sense, not random guesses. Since you already understand how these two indicators work individually, now I'm going to show you how they work together to tell you exactly when to buy and when to sell. But before we talk entries, you must understand what a valid buy signal and a valid sell signal actually look like with this combo. Let's start with a valid sell entry. Rule number 1, RSI must be below 50. That tells us one thing immediately. Sellers are in control. The market is bearish, no debate. Next, watch 𝗚𝗏𝗪 very carefully. 𝗚𝗏𝗪 will temporarily move upward, crossing above the RSI line, even though RSI is still below 50. What does that mean? Price just pushed too high in a bearish market. It's expensive, it's stretched, it's vulnerable. Then comes the moment we're waiting for. 𝗚𝗏𝗪 turns back down, crossing below the RSI again, while RSI stays below 50. That's the confirmation. That's price failing to hold higher levels. That's bearish momentum snapping back into control. This is your valid sell entry signal from the RSI plus 𝗚𝗏𝗪 combination. But we don't stop there. That sell becomes fully confirmed only when the candlestick position agrees with the 20-period EMA and 50-period EMA, meaning price respects those moving averages from below. That's how you avoid fake moves. That's how professionals trade. Now let's flip the script. Here's a valid buy entry. First rule, RSI must be above 50. Instant message, buyers are in charge, the trend is bullish. Next, 𝗚𝗏𝗪 temporarily drops below the RSI line while RSI stays above 50. What's happening here? Price just became too cheap in a bullish market. It's a pullback, not a reversal. Then comes the trigger. 𝗚𝗏𝗪 snaps back up, crossing above RSI then while RSI remains above 50. That's momentum returning. That's buyers stepping back in. That's the trend continuing upward. This is your valid buy entry signal from the RSI plus Williams R combo. And just like before, that buy becomes rock solid when price action confirms it around the 20 EMA and 50 EMA. Now, you're not guessing. You're aligning momentum, trend, and structure. Honestly, even just RSI and Williams R alone already give you a shockingly accurate picture of the market. But when you layer in the 20 period and 50 period EMA, you turn a strong strategy into a laser-focused trading system, and this is how random charts turn into clear decisions. Alright, now we're diving into the final piece that turns this whole strategy into a weapon. We're breaking down the 20 period EMA and the 50 period EMA, and trust me, this is where chaos turns into structure. First, let's make this insanely simple. These two EMA lines have two main jobs. No guessing, no confusion, just clarity. Job number one, trend filter. The rule is brutally simple. If the 20 EMA is above the 50 EMA, the market is bullish. If the 20 EMA is below the 50 EMA, the market is bearish. That's it. That alone already tells you which side of the market you should even be thinking about. Sell-focused or buy-focused. No emotions involved. Now job number two, trend strength. Look at the distance between the two lines. When the gap between EMA 20 and EMA 50 keeps expanding downward, that bearish trend is getting stronger. Sellers are accelerating. Momentum is increasing. When the gap widens upward, the bullish trend is gaining power. Buyers are stepping on the gas. So these EMA lines don't just tell you direction, they tell you how serious the trend is. Now, here's where most traders mess up and where you level up. You already have a valid entry signal from the RSI plus Williams R combo, great. But the real question is, where should that signal appear on the chart? Let's start with a bearish market. When EMA 20 is below EMA 50, the market is officially bearish. That means your priority is sell, not buy. But listen carefully, you do not sell while price is falling. You wait. You wait for price to pull back upward into the space between the two EMA lines. That zone between EMA 20 and EMA 50 is not random, it's a dynamic resistance zone, a supply area that moves with the trend. So the rule is simple. A valid sell signal from RSI plus Williams R must appear after price retraces upward into the EMA 20-50 zone. Why? Because that's where sellers reload. That's where institutions defend the trend. That's where weak buyers get trapped. When RSI and Williams R show overbought or bearish reversal inside that EMA zone, you're not guessing anymore. You're selling the structure, momentum, and probability on your side. This gives you better risk reward, tighter stop loss, higher chance the trend continues. Now, flip everything. Let's talk bullish market. When EMA 20 is above EMA 50, the market is bullish. Buyers are in control. Momentum is upward. But again, you do wait for price to pull back downward. That pullback should enter the space between EMA 20 and NA 50, now acting as a dynamic support zone. This zone represents temporary profit taking, not trend reversal. So your rule becomes, a valid buy signal for RSI plus Williams R must appear after price pulls back into the EMA 20-50 zone. When RSI shows bullish strength and Williams R signals oversold or bullish reversal inside that EMA zone, you're buying at a discount inside a strong trend. That's how professionals enter. Not chasing candles, not panicking, just waiting, then striking. Here's the core logic. Burn this into your brain. EMA 20 versus EMA 50 tells you the trend direction. RSI and Williams R tells you the timing. Best entries happen on pullbacks, not impulsive moves. This structure helps you. Avoid trading against the trend. Filter out fake oscillator signals. Trade in sync with momentum and market structure. And when all of this lines up, you're no longer reacting to the market, you're anticipating it. That's how randomness turns into the system. And that's how this strategy becomes dangerous, in a good way. Alright, now lock in, because this is where everything comes alive. We're about to tear this chart apart, piece by piece, so even if you've never traded before, you'll see it clearly by the end. Step 1. Your eyes snap straight to the EMAs. No indicators first, no candles first. Your brain instantly asks one question, who's in control right now? And the answer is obvious. The 20 EMA is below the 50 EMA. That alone already tells you the market bias. Bearish. But here's the kicker. Look at the space between them. It's wide, it's stretched, it's clean. That gap is not decoration. That gap is a message. It's screaming, this downtrend is strong. This is not a weak market. This is not chop. This is sellers pressing the gas pedal. Step 2, we verify with RSI, no guessing allowed. Now your focus drops to the RSI, and this is where amateurs get emotional and pros stay calm. What do we see? RSI is consistently below level 50, not flirting with it, not breaking above it, living under it. That means sellers are still dominating momentum. And then, perfect alignment, the Williams-R line stays below the RSI. This is huge. EMA says bearish, RSI confirms bearish, Williams-R agrees. 3 different tools, same conclusion. That's not coincidence, that's confluence. Step 3, the moment that confuses beginners but excites professionals. Williams-R starts moving upward, crossing above the RSI. Most beginners panic here. Price is going up. Is the trend over? No. Relax. Look again. RSI is still below 50. That means this price increase is not strength. It's a pullback, a temporary retracement inside a dominant downtrend. The trend has not changed. The structure is still bearish. This is the market taking a breath before continuing lower. Step 4, now we go back to the price chart, and this is the money zone. Price pushes higher and enters the area between EMA 20 and EMA 50. This zone is not random. This is the main resistance zone in a strong bearish market. Think about it like this. If sellers truly control the market, this is as high as price is allowed to go. When price reaches this zone in a strong downtrend, it's considered expensive, too expensive for buyers, perfect for sellers. That's why this area becomes the highest probability sell location. You're not selling low, you're selling high in structure. That's how you get bigger reward, smaller stop loss, cleaner execution. But rules matter. If price breaks and holds above EMA 20 and EMA 50, this strategy immediately flips the switch. Bearish bias is no longer valid. Sell only mode is off, buy only mode is on. No emotions, just logic. Step 5, protect yourself like a professional. Before you even think about profit, you lock in risk. You have 2 clean stop loss options. First option, place it above the nearest swing high. Second option, place it above the 50 EMA, the line that defines the trend. Both keep losses controlled. Both prevent disaster. And here's the beautiful part. When a valid RSI plus Williams-R combo appears inside the EMA resistance zone, price usually doesn't hesitate. It moves fast. It drops hard. It respects structure. That's not luck. That's preparation meeting opportunity. This is how random trading turns into repeatable execution. And once you train your eyes to see this sequence, you'll never look at charts the same way again. All right, lock in again, because now we flip the script. This is the bullish scenario, and this is where things get really exciting. The very first thing your eyes catch instantly is the EMA structure. No hesitation, no debate. The 20 EMA is clearly above the 50 EMA. That alone already tells you one thing loud and clear: the market is bullish. But don't stop there. Look at the difference between them. It's wide, it's clean, it's expanding. That space is momentum. That space is confidence. That space screams, this trend is strong. This is not a weak bounce. This is not a lucky move. This is buyers fully in control. Step 2. Now we confirm with RSI, because pros never rely on one signal. Your eyes drop to the RSI and immediately you see it. RSI is holding above level 50, not dipping below, not struggling, staying strong. That means momentum is still bullish. And look closer. Williams-R is also above the RSI line. That's alignment. EMA says bullish, RSI confirms bullish, Williams-R agrees. 3 tools, 1 direction. That's how you remove doubt. Step 3. Here's the moment beginners panic and professionals get excited. Williams-R starts moving down, crossing below the RSI. But RSI is still above 50. This is critical. Price pulling back does not mean the trend is dead. It means the market is breathing. This move tells us something powerful. Yes, price is dropping, but buyers are still in control. This is not weakness. This is opportunity forming. Step 4, now shift fast to the price chart. This is where the setup is born. Price drops right into the zone between EMA 20 and EMA 50. This zone is gold. In a strong bullish trend, this area acts as dynamic support. Think about it like this. If buyers truly control the market, this is as low as price is allowed to fall. When price reaches this zone, it's considered cheap inside a bullish structure. That's why this becomes the best possible buy location. You're not chasing price. You're not buying the top. You're buying the pullback. That's how you get massive reward potential, minimal stop loss, maximum precision. And rules still matter. If price breaks and holds below EMA 20 and EMA 50, this strategy instantly switches bias. Bullish mode is off. Buy only becomes sell only. No emotions, no hope, just structure. Step 5. Now you protect capital like a sniper. Before dreaming about profit, you define risk. 2 clean stop loss options. Option 1, place it below the nearest swing low. Option 2, place it below the 50 EMA, the backbone of the bullish trend. Both are logical, both are tight, both keep losses small. And here's the beautiful part. When a valid RSI plus Williams R combo forms inside the EMA support zone, price usually doesn't crawl, it explodes. Fast moves, clean continuation, strong follow through. That's not luck. That's structure plus momentum plus timing working together. This is how random entries turn into repeatable, high probability trades. And once your brain understands this bullish sequence, you stop guessing and start executing with confidence. All right, now let me show you another insane power of this trading strategy. And trust me, this is where everything starts to click. So lock in, because once you see this, you won't be able to unsee it. The very first thing your eyes should snap to on this chart is the EMA struck to 20 period EMA and the 50 period EMA. And look at this clearly. The 20 EMA is sitting above the 50 EMA. No guessing, no confusion. That alone already screams one thing loud and clear: the market is in a bullish trend. But we don't stop there. We never stop at just one signal. So the next move, we zoom straight down to the RSI. This black line right here in the sub window is doing something beautiful. It's holding strongly above level 50. That tells us buyers are in control. Momentum is healthy. This isn't a weak bounce. This is a real trend. And then, check this out. The red Williams R line is also staying above the RSI line. That's massive. That combo confirms we're not just bullish, we're in a strong bullish environment. Now here's where the magic starts. Step 3. Watch the Williams R closely. You'll see it dip down and cross below the RSI for a moment, but notice this. RSI never drops below 50. That tells us something critical. Yes, price is pulling back, but the trend is still bullish. This is not a reversal. This is a reset. So what do we do next? We jump back to the price chart fast and look at this move. Price drops cleanly into the EMA zone, right between the 20 EMA and the 50 EMA. This zone is gold. This is not random. This area acts as a dynamic support zone in a strong uptrend. Think about it like this. In a powerful bullish trend, when price pulls back into this EMA zone, the market is basically saying, all right, discounts are back. Who wants in? If price bounces from this zone, that means the bullish trend is continuing. And this zone becomes the lowest risk buy area you could ever ask for. Small stop loss, massive upside. Price reacts perfectly off the EMA zone and starts pushing higher again. So now we look back at the indicators and boom, Williams R rockets back up, crossing above the RSI, while RSI is still holding strong above 50. That's it. That's the moment. This is a valid buy entry. No guessing, no emotions, no hope. We entered buy on the next candle. Clean, confident, calculated. Now let's talk risk, because this is where amateurs panic and pros dominate. We've got 2 solid stop loss options, below the nearest swing low, below the 50 period EMA. In this case, the nearest swing low sits just slightly below the 50 EMA. Perfect. That gives us a tight stop, controlled risk, and maximum upside. But wait, here's where it gets even crazier. Something special happens next. Price moves up, then pulls back again into the EMA zone. And guess what the indicators do? Williams R drops below RSI again. RSI still refuses to fall below 50. That means the bullish structure is still intact. Then, boo, price pushes up again and Williams R crosses back above RSI. Now pause right here. You already have an active buy position. So what do? This is where smart traders level up. This isn't a warning. This is an opportunity. This is a chance to maximize profit. So we execute a second buy entry right at the next candle open. Stop loss? Same logic. Below the nearest swing low, still protected, still disciplined. And then it happens. Price explodes upward, continuing the bullish trend and delivering massive gains. This type of setup happens all the time in Forex, in stocks across markets. And miss it VAT scaling in technique? This is what serious stock investors use to compound returns inside strong trends. No chaos, no overtrading, just structure, timing, and discipline. This was not just a strategy, this is a system. And when you truly understand this logic, trend first, timing second, execution last, you stop gambling and you start trading like a professional. Last, I'm going to prove to you that this strategy is insanely powerful at finding high probability entries, even when the market looks chaotic, wild, and completely out of control. Look closely at this chart. First, notice the 𝗬𝗂20 sitting above the 𝗬𝗂50. That alone already tells us something huge. Based on moving averages, the market structure is bullish. But now here's where things get interesting. Even though the trend is bullish, price suddenly drops way below both the 𝗬𝗂20 and 𝗬𝗂50, yet the 𝗬𝗂20 never crosses below the 𝗬𝗂50. The bullish structure stays intact. This right here is an anomaly, a moment where price behavior and trend structure don't match. Then price pushes back up and breaks above both EMAs again. But wait, now the 𝗬𝗂20 is actually below the 𝗬𝗂50. That's a bearish formation. This is the second anomaly, and this is critical. You do not buy here. This is not an entry. This phase is only the market preparing to turn bullish, not confirming it yet. Now watch what happens next. Price continues moving up, and then the 𝗬𝗂20 finally crosses above the 𝗬𝗂50 again. At the same time, price is trading above both EMA lines. That's our first major confirmation. Then we look at momentum. The RSI line is holding above the 50 level, and the Williams R line is sitting above the RSI. Now everything aligns. Trend, structure, and momentum all screen the same thing. The market is now fully validated bullish. Next, price pulls back. Williams R drops below the RSI, but RSI stays firmly above 50. That tells us something powerful. This is not a trend reversal. It's just a temporary pullback inside a strong bullish trend. And now this is the moment you've been waiting for. Price turns back up. Williams R crosses back above the RSI, and that is your clean, high probability buy signal. No guessing, no hope, just confirmation. You enter the buy at the open of the next candle. Simple, clean, precise. Where's the stop loss? Easy. Place it just below the nearest swing low. Why? Because that swing low sits slightly below the RSI structure, giving you maximum protection with minimal risk. And then boom, the market explodes upward, continuing the bullish trend and delivering a solid, clean profit. By now, you should clearly understand how insanely precise this strategy is. Not only does it find the right direction, but it waits patiently for the right moment. And most importantly, it's simple enough that you can actually execute it correctly, as long as you stay disciplined and follow the rules exactly as explained. The best part? You can build this trading system yourself. It's incredibly easy. Every indicator used here is available on every major trading platform, but if you want the exact same setup you see in this video, no guesswork, no manual plotting, I've got you covered. You can download the full indicator template and trading system directly from the description. Just add it to your chart and everything will be plotted automatically, accurately, and instantly. No hassle, no confusion. Just focus on learning, executing, and improving your trading skills. And as always, if you learned something new or if you want more videos like this more often, make sure you subscribe, turn on notifications, and share this video with your WhatsApp groups, Facebook friends, or on X to show your support. I'll see you in the next one.